Hey there, it's Jerry Smith. Today I want to spend a little time talking about a term called debt-to-income ratio. Lenders will normally refer to this as DTI. Now, the whole point of this video is to make sure that you will, one, understand what debt-to-income is, and number two, why it's important. Okay, so let's start with what it is. Debt-to-income ratio is the comparison between what your monthly income is as well as what your monthly obligations, debts, what those are, okay? And they break it down into a percentage. So they're going to look at what your existing debts are, whether it be car payments, auto loans, credit cards, anything like that. And then they're also going to look at what your future payments will be, so the mortgage that you're applying for, all right? And they're going to factor all that in. So for example, let's just look at this. Let's say that your annual salary is $60,000 a year. If you break that down into a month, that's $5,000 a month of gross income. The lender's going to look at your gross income for DTI. And then they're going to look at your credit report and they're going to say, okay, what are your monthly debts? And let's just say that the mortgage that you're applying for, with taxes, insurance, principal and interest, everything included, is $1,500 a month. And then let's just say you have an existing auto loan of $400 a month. And let's say you have two credit cards and the minimum payment on those is $50 each. Well, if you add the $1,500, the $400, and the two $50 payments, you're going to be at $2,000 a month is what your monthly obligations are as far as loans go. And that's going to be compared to what your monthly gross income is of $5,000. Well, 2,000 divided by 5,000 is 40%. That means that you have a 40% debt-to-income ratio. Now that's called back-end debt-to-income ratio, like everything included. The other number that your lender is going to look at is something called front-end debt-to-income ratio. That is going to be what your mortgage payment makes up of your gross income. That's another important number. So in this case, we have a $1,500 mortgage we're applying for, and our gross income is $5,000 a month. That means $1,500 divided by 5,000 is 30%. That means that your housing expense or your mortgage payment makes up 30% of your gross income. So from a debt-to-income standpoint, the lender's going to say you have a front-end ratio of 30% and you have a back-end ratio of 40%. Every lending program is different. So whether you're looking at a VA loan, conventional loan, USDA, FHA, whatever it might be, they're going to have different guidelines as far as risk when it comes to debt to income. So it's very important to have this discussion with your lender and to understand what you are really can afford from an affordability standpoint as it relates to your debt to income. If you have any specific questions about your situation, please reach out to me directly. My phone number is below as well as my email. I'll talk to you soon and have a great day.